A critical shift in global technology just unfolded, and it could reshape the balance of power for years to come. The Trump administration has canceled TSMC's special waiver, ending the company's ability to ship advanced American chip-making equipment to China without approval. Beginning this December, every delivery will require explicit government authorization. Samsung and SK Hynix now face identical restrictions. The consequences reach far beyond Asia. Supply chains across Taiwan, South Korea, and Europe will face mounting costs and delays. While Washington buries its allies in regulatory hurdles, Chinese chipmakers like SMIC continue expanding, and Beijing accelerates its push into artificial intelligence. But there's another crisis brewing beneath the surface. U.S. Treasury bonds are in free fall. The 30-year yield has surged back toward 5%, driving bond prices down and pushing borrowing costs higher across mortgages, business loans, and government debt. Investors worldwide are selling, spooked by ballooning deficits, inconsistent policies, and a recent court ruling that threatens billions in expected tariff revenue. What's breaking isn't just markets, it's trust. U.S. bonds, long considered the world's safest asset, now demand higher returns just to attract buyers. Pension funds and central banks are pulling back. Political battles threaten the Federal Reserve's independence, yet Washington keeps spending. Connect these threads and a stark picture emerges: America isolating its allies, China advancing steadily, and U.S. finances under mounting strain. This isn't abstract policy. It touches your savings, your job security, your future. Stay with me. I'll break down what's happening, why it matters, and why the coming months could be more volatile than most realize. The chip waiver revoked. Last week, Washington eliminated TSMC's exemption, the arrangement allowing the company to freely export U.S.-made chip-making tools to its facility in Nanjing, China. Starting December 31st, every shipment requires individual licensing. TSMC isn't alone. Samsung and SK Hynix are now under the same framework. What was once seamless trade has become a bureaucratic maze. The slowdown doesn't just impact China, it hampers America's closest partners. This comes as China accelerates AI development. Firms like DeepSeek are deploying autonomous AI agents that rival OpenAI's capabilities. Their progress is measurable and rapid. Yet instead of targeting Beijing directly, Washington has entangled its allies in the crossfire. Factories in China operating normally now risk prolonged delays, not from Chinese regulations, but from American licensing backlogs. Consider TSMC's Nanjing plant. While it represents a modest revenue share, the real danger isn't financial, it's operational. Delayed licenses could halt production entirely. Samsung and SK Hynix face identical uncertainties. Their question is no longer, can we manufacture, but will critical tools even arrive? These companies are trapped between compliance with Washington and control over their supply chains. Meanwhile, U.S. firms like Nvidia continue business in China, generating revenue while foreign partners absorb losses. The message to allies is unmistakable. What's framed as national security increasingly resembles a strategy to redirect investment and manufacturing back to American soil, even at allies' expense. There's a dangerous irony here. By blocking partners from the Chinese market, Washington may accelerate the very outcome it seeks to prevent. Domestic Chinese firms like SMIC and Huahong will expand faster, capture market share, and achieve self-sufficiency. Once Beijing reaches that threshold, reversal becomes nearly impossible. This isn't rhetoric, it's policy that could fragment global supply chains, strain alliances, and hand China the technological independence it's been pursuing. The Arizona gamble. Washington's next move: bring chip-making home. The centerpiece is Arizona, where TSMC has committed up to $165 billion across 6 facilities covering advanced fabrication, packaging, and research. The U.S. is backing this with $6.6 billion in direct grants and $5 billion in loans through the CHIPS Act. On paper, it's the perfect solution. Relocate the world's leading chipmaker to American soil. But the reality is daunting. TSMC controls over 70% of the global foundry market. For every $10 spent worldwide on contract chip manufacturing, $7 flow to TSMC. These aren't commodity chips. They're processors powering AI, smartphones, cloud servers, and high-performance computing. Asking TSMC to replicate that capacity in Arizona isn't a simple relocation. It's rebuilding the core of global technology from scratch. Arizona is already revealing the challenges. Fab 21 targets 4 nanometer, 3 nanometer, and eventually 2 nanometer production, among the most advanced nodes in existence. Success requires not just facilities and equipment, but a highly skilled workforce. Estimates suggest the U.S. needs hundreds of thousands of new specialists. Those skills are scarce. Delays have forced TSMC to fly in Taiwanese engineers to train American workers, sparking political friction. The project missed its 2024 deadline, and obstacles remain. Trump's vision of rapid reshoring collides with the complexity of building the world's most sophisticated technology ecosystem. Meanwhile, China moves in the opposite direction. SMIC and Huahong expand domestically. Beijing spent years preparing for supply chain disruption, investing heavily to ensure independence. That preparation is paying off. Ironically, the U.S. now faces greater risk than China if chip flows are disrupted. Washington remains heavily import-dependent while Beijing has steadily reduced reliance on foreign suppliers. The AI race accelerates. While chip battles rage, artificial intelligence is advancing even faster. For the United States, this isn't just competition. It's about controlling tools that define economic power and military strength in the 21st century. Chips provide the hardware. Large language models provide the software. Right now, OpenAI's ChatGPT holds the global standard, stable, trusted, embedded across industries. But China's DeepSeek has closed the gap at unexpected speed. By early 2025, Washington officials warned America's lead had shrunk from years to mere months. The concern extends beyond technology. Despite billions invested in U.S. AI startups, the business model is fragile. Roughly 95% of American AI companies fail within months, burning funding without achieving stability. China's progress shows intangible results. DeepSeek's R1 and V3 models, built with approximately 2,000 Nvidia GPUs and only single-digit millions in budget, reach performance benchmarks in reasoning and coding that match or even exceed ChatGPT's latest versions. The efficiency is remarkable, rivaling a billion-dollar company with just a fraction of the resources. That momentum translates into market share. In January, DeepSeek's app topped the U.S. App Store, surpassing ChatGPT as the most downloaded free application. It wasn't symbolic. It demonstrated how quickly Chinese platforms can capture users even in America's home market. The surge rattled Washington. OpenAI leaders have warned that DeepSeek's lower costs could reshape the global AI landscape. If American models appear expensive and slow, while Chinese alternatives deliver cheaper, faster solutions, the balance could shift sooner than expected. Nvidia caught in the crossfire. One company sits at the center, Nvidia. Its graphics processors power both OpenAI's ChatGPT and China's DeepSeek. These chips are the engines enabling massive language models to scale. Without Nvidia's hardware, current AI breakthroughs would stall. Every Washington policy lands on Jensen Huang's desk, Nvidia's founder and CEO. Huang has called China's AI market a $50 billion opportunity, not just profit, but the foundation of Nvidia's long-term growth. Losing that market, he warns, would cost tens of thousands of jobs, slow American innovation, and weaken U.S. influence in this critical technological race. But Trump's shifting restrictions, alternating between tightening and easing, have made China a geopolitical minefield for Nvidia. One misstep could sever access to its fastest-growing customers. Simultaneously, Washington's pressure fuels international suspicion that U.S. policy aims not only to slow China, but to control where global companies can profit. For Nvidia, the uncertainty is paralyzing. It must balance protecting business interests against appearing to defy its own government. While tech firms navigate these hazards, America faces strain at the core of its financial system. The bond market breaks. The U.S. bond market is flashing warning signals. Long-term Treasuries, once the world's safest asset, are under severe pressure. The sell-off has intensified, pushing yields to levels unseen in decades. The 30-year Treasury has climbed above 5%, a threshold last touched in July. This isn't abstract. It means Washington pays far more to borrow, and higher costs cascade into mortgages, corporate loans, and consumer credit. The stress is global. In Japan, long-dated government bonds hit 3.3%, the highest on record. In Britain, the 30-year gilt surged to 5.7%, last seen in 1998. These moves signal worldwide investor anxiety. Higher borrowing costs hammer government budgets directly. The US, Britain, France, and Japan carry enormous debt. Previously, pension funds and institutions stabilized markets by purchasing long-term bonds. Now many are retreating or demanding sharply higher yields. That shrinking demand drives costs even higher, transforming finance's safest corner into one of its most volatile. Pressure intensified after a federal appeals court ruled most Trump tariffs illegal. The financial implications are massive. Governments counting on steady tariff revenue now face potential refunds. Billions in expected income could evaporate, blowing fresh holes in budgets. For bondholders, it's another reason to question whether governments can control deficits. The timing couldn't be worse. Brief relief came when weak U.S. job data suggested economic cooling, nudging yields lower. But calm didn't last. The broader picture shows investors abandoning long-dated government debt and seeking alternatives. Gold is one such refuge. Spot prices have surged to new highs, reflecting deep trust erosion. Many investors now consider gold safer than bonds themselves. This bond market crisis is just beginning. Consequences will reach every economic corner, from savings and pensions to borrowing costs and currencies. The impact will be widespread and painful. What comes next? The patterns are clear. America is isolating allies through restrictive policies. China is advancing toward technological self-sufficiency. U.S. financial credibility is eroding as bond markets revolt. These aren't separate crises. They're interconnected pressures that could accelerate rapidly in the months ahead. The question isn't whether disruption is coming, it's how severe it will be, and whether the current approach can hold together under mounting strain. One thing is certain, the world order built over decades is shifting beneath our feet, and the tremors are only getting stronger.